Hello, it's Jonathan Wellum of Rocklinc Investment Partners, and we are all set for our March webcast. We've entitled this Emergencies Act. Just to let you know that you should read the disclaimer, just to keep us on side with all of the lawyers. And let's just jump right into the presentation here. I'm going to talk very quickly about our investment philosophy, investment challenges, along with market challenges. A couple of words about the Emergencies Act, and then talk a little bit about our performance summary. And then Jesse Vandermeer and Andrew Chang are going to talk about the impact of rising interest rates on our investments, along with the issue of stock splits, which we've seen now in a number of our securities. Okay, in terms of Rocklinc Overview, we're now, we started in 2010. We're managing a little over $240 million, and we have about 225 households, and actually growing quite quickly, especially in the last couple of months. We focus on customized portfolios, and we try to be very independent in how we invest, differentiated from the masses, from the typical way that people are going to invest if you're at the banks or life insurance companies and so on, as I think most of our clients are very aware. In terms of our investment philosophy, again, we're looking for excellent companies. That means they're going to have great fundamentals, things like returns on equity, balance sheets, strong free cash flow, reoccurring revenue. We typically run focused portfolios, as I think our investors are very aware. We're not all over the place. We zero in on certain industries, certain businesses, and then take larger positions. We want to make sure that we're there for reasonable holding time frames so that we're allowing the businesses to grow, and we also have the benefit of tax-deferred compounding. Purchase with a margin of safety, which is critically important. As we've talked about the last couple of years, securities have become very expensive, and we've seen them come off a fair bit. In the first number of weeks of this year, we've seen pretty down, large down markets around the world, with the exception really just of the Canadian market, which has been propped up by commodities. And then understand the economic and political backdrop. In terms of investment challenges, we continue to talk about these things. I've added a few more here over time because of the crazy world that we do live in. But global debt levels are well over $300 trillion. At the turn of the century, 22 years ago, that number was 70 to 80 trillion. So we've seen this massive expansion in global debt levels. Governments continue to promise that which they cannot deliver. It doesn't stop them from promising, of course. The demographics are brutal. Birth rates, just in the last 2 years, have just plummeted, which means you're not replacing the population. You have this massive aging population. Monetary policies, printing money, repressing interest rates have been the mainstay of our economy really since the financial crisis back in 2008. Interestingly enough, we're seeing substantial inflation finally for a number of reasons, and we're also seeing interest rates actually slowly going up. So we have monetary tightening. What does that mean? And how are we positioned for that? And then I want to make a few comments about the Emergencies Act that was put into play by our Prime Minister. Now, in terms of market challenges, significant inflation, I would just say. I would sort of run through all of what's taking place here. Stock market valuations are still high, although in some areas they're more attractive. And we've been very careful. We haven't really suffered from a large downstroke in values because we tried to avoid overvalued securities in the first place. And there are better values emerging, which is exciting. Central banks, are they able to taper money printing? Are they able to increase interest rates very much? We don't think so. If they do, cut back on the money printing and also increase interest rates to the extent that they're talking, we think a contraction or a recession by the end of the year would be quite probable, and so we want to be careful. Significant increase in debt levels continue. We've talked about that. Dramatic increase in inflation. I think everybody's talking about inflation. Asset prices, commodities, food costs. This is the highest in over 40 years. I have to go back to my high school days to remember these kinds of levels of inflation. The government stats tell us it's 6 to 8%. We know it's higher than that, and housing prices alone are up 40, sometimes 50% since the March 2020. So we've seen substantial inflation, and I don't think it's going away anytime soon, because a lot of this inflation has been because of policy decisions. In other words, been driven by government policies. And so trying to reverse those policies is a lot tougher. We've also seen structural deficits. Governments are addicted to debt. In Canada, we've got a bill that's in third reading currently as I speak on March the 18th. And it's pushing this whole universal basic income, pay everybody a basic income, which is just a crazy economic idea. It will not work. It will stress our balance sheet. It will put money in the hands of people who don't deserve it, and it will have to tax people who are actually the productive class. It's their money in the first place. So we have this forced redistribution of wealth that could be coming on Canada that will have a very, very detrimental effect on our economy. Citizens are oblivious to the financial situation that you see around the world. It's very precarious, and now we have a war in Europe with Russia invading Ukraine, which I don't have to tell any of you about, and that's having a major impact on basic materials. Commodities, food costs are going to continue to rise. Ukraine is a big producer of food. There's also a lot of basic commodities and materials that come out of Russia and Ukraine. And if those are impacted in the market, as we've already seen, you're going to get substantial price hikes. This will be inflationary and continue to be inflationary. And then modern monetary theory, which we've talked about a little bit over the last couple of years, has really failed. This idea that you can just print money and the government will allocate it perfectly and not create inflation. That sort of thinking is absurd, and we've seen that this whole idea of modern monetary theory has failed. But will that get through to the politicians? Probably not. And so again, we want to be careful. In terms of marketing position, when we look at companies, when we're buying into businesses, we pay attention to valuation, as we've already talked about many, many times. There's some stocks are just ridiculously overvalued. They've come down a lot. Balance sheet strength is critical. We invest in hard assets, examples, infrastructure, real estate type businesses. We keep significant weightings in precious metals through leading royalty or finance companies in that space. In 2021, it's interesting, that space really underperformed. Didn't do very well, held us back actually a little bit. The first 3 months of this year, almost 3 months of this year, that's been one of the best performing areas. And so it really does act as a counterbalance, as a hedge. And we want those positions because when things get messy, the precious metals always do well. And then we invest in essential industries with above average growth, things like technology, healthcare, consumer staples, water, agriculture. We're in the businesses that have longevity and long-term value, and they can adjust best for inflationary conditions. Now, let me just say something about the Emergencies Act. All Canadians should be very concerned with what happened back in February. This was enacted on February the 14th. Fortunately, it was pulled a couple of days later. But let me just quote on the rationale for the Emergencies Act, when it should be actually invoked. And we don't have time to go into a lot of details, but I just want to make a couple of quick comments. And I quote, "Temporary, urgent, and critical situation that seriously endangers the lives, health, or safety of Canadians and is of such proportions or nature as to exceed the capacity or authority of a province to deal with it." Clearly, that wasn't the case. There was no way that the situation in Ottawa or the situation in Windsor warranted anything like the Emergency Act, and yet that was pulled. Now, it exposed the overreaching powers of the state and our federal government here in Canada, and the willingness of the government to target political opposition. And that should concern all of us as Canadians, regardless of what party you support, that the government would use an extreme measure like the Emergency Act to actually target its political opponents. And so what we've seen here is that crowdfunding platforms, payment service providers must now register with FINTRAC. That's the Financial Transactions and Reports Analysis Center of Canada. We already have a lot of reporting that goes to FINTRAC, and they monitor all these different transactions, looking for legitimate things like terrorist money or money that's coming from sources that is criminal in terms of its activity. But that was certainly not the case when it came to the crowdfunding platforms with the trucker convoy recently. And Canadian financial institutions have also been weaponized, as I say on this chart, against political opponents of the government without due process, without going to the courts. and Canadians' accounts can be frozen, and Canadians can be frozen out of their investments and bank accounts at the whim of the government without any legal recourse. This is very, very serious. And we haven't seen this in other Western countries. And so this should, again, concern Canadians. I know it does concern our clients. I've talked to probably close to half our client base, and great concerns over the overreach of what we've seen here with our federal government. And the worst part about this is we now know, because of Commons, in the House of Commons, there's been a number of sittings and sessions where they've interviewed more and more people to find out what was going on over those early weeks of this year. And we now know that the threats from the protests that Trudeau and Christy Freeland used to justify the Emergencies Act were totally untrue. In other words, we had politicians come to us and tell us of these threats that they felt were upon us, and they were untrue. And that's all coming out now as the conversation is being extended there in Ottawa. That alone should mean that some of these politicians should be stepping down. And it should really concern us that they can actually lie to us and misrepresent the reality to bring a level of fear to enact something like the Emergency Act here in Canada. And so some implications, I would say to our clients, I've talked to quite a few of them, keep some extra cash around your home. ATM machines can be exhausted very quickly, as we saw when people went to get some money out of the bank. Banks are no longer in the business of giving you cash. You can get a little bit of cash, but they don't have much in terms of reserves. And the banks now really are vassals of the government. Let's be honest about it. That's what they really demonstrated to us. They're in the back pocket of the government. They're governed by the government. They're regulated by the government. And they will jump to whatever the government says. Second, think about owning small amounts of physical gold or silver. These are monetary substitutes. You can use these for barter. And for some of you who feel comfortable, of course, Bitcoin could be something that's interesting, and you can, again, transport that across borders, and gives you financial flexibility. Open a bank account if you can outside of Canada, outside the immediate reach of our government. And so you have some financial flexibility. And if possible, own assets outside of Canada. Investment accounts, real estate, etc. And so my comments here, unfortunately, is that we need to actually try to build some protection against our own government. And so be wise, be prudent, diversify, and don't be naive to the issues. Now, one of the things that we're looking at, we've actually been looking at this for the last 2 years or so, but we've really sped this up because of the Emergencies Act and that being put into play and then being pulled back. But it gives us a sense of what the government thinks of us as Canadians. And remember, if they can target one group, they can easily target another. So if they have power to abuse with one group, they can easily abuse that on another. So just because you might say, well, I don't necessarily like those people, or whether you really like them is irrelevant. The fact that a government can, without due legal process, go after people like that should be shocking and concerning to you. So Rocklinc, we're actually looking to launch an investment fund based in Cayman Islands. Cayman's the #1 jurisdiction in the world for offshore funds. We will look with this fund to have a fund custodian and administrator and legal counsel and auditor that will all be based in the Cayman Islands. It will be completely outside of Canada and open to Canadian and non-Canadian investors. The minimum will be about $100,000 US, but we want to provide an option for our clients and for future clients that they can actually have a really well-run investment account, but have it domiciled outside of their country in which they live. This fund will be a basket of our top stocks, 25 to 30 stocks. Liquid, it would be, you can go in and out of the fund once we get it up and going, basically within a month. Every month, you can go in, you can buy and sell, and the management fee would be just similar to what we charge in our existing business. This is not an avenue for higher profits for us. This is just an avenue in which we can serve our clients in the environment in which we find ourselves. The anticipated launch will be June 1st, and we've had a lot of interest from investors. A lot of interest. So call or email if you are interested. Just reach out to us, let us know, and we'll put you on the list, and we'll keep all of you, of course, informed on any new developments here in terms of the We call this the Kokomo Fund, and just having a little bit of fun with that name. In terms of performance summary, we've chugged along pretty good here, and you can see here as of the end of February, our book of business, this is looking across all of our accounts. We were up a little bit in February. We are actually up in March despite a negative March so far. The month is not over yet. And over the last year, 8%, last 5 years compounding at 9.2%, over the last 10 years compounding per year 7.8%. That's after all fees. That's across our book of business, including stocks and bonds. If you want to look right at our equity performance, this I find quite interesting. You can see here, if we look at just our equity performance based upon our Canadian U.S. stocks, we can see that in Canada in particular, we've really done very well over the last month, 3 months, 6 months, 1 year. And that's because of the precious metals holdings. They've gone up a lot, and some of our investments in that space have really paid off. Versus the U.S., that's the market that's been hit the hardest in terms of the North American markets, with the NASDAQ down over 20%, S&P 15%, the Dow Jones a similar amount from peak to trough. And we're holding up quite well in those markets, but I must say it's actually the Canadian side this time, which has been really buttressing the portfolios and keeping us out of trouble. And that's the same thing in March. We're actually outperforming the markets substantially in the month of March. So in terms of, and just to give you a sense of the first 48 trading days, and that really takes you up to just early days, probably about March 14th of this year. You can see if you look at this closely, the prints there are a little bit small, but you can see if you take the first 48 trading days and you go all the way back to 1928 and then fast forward to this year, 2022, this is the fourth worst start in all of those years. And so in the first 48 trading days, we're down about 12%. And so you can see it's been a tougher year to start, and we're happy that we've been hanging in there and generally are either up a little bit or just flat to slightly below the zero mark despite a substantially negative market. So with that, I'm going to hand it over to Jesse and then Andrew. Jesse's going to talk about the impact of increasing interest rates on your investments. And this is an important topic, and so we thought we'll address that. And then Andrew's going to talk about stock splits. We've had quite a few companies in our portfolio that have split their stocks, and a lot of times, our clients will ask us questions about that. Andrew's going to answer all your questions. So over to Jesse.
Today I'll be talking about capital structure and rising interest rates, which we've certainly been in a rising interest rate environment for the past couple months. We've seen tremendous volatility in the capital markets, both equity and the fixed income markets. So I thought it'd be an opportune time to talk about how our businesses handle their debt and what they do to manage their capital structure. A company's capital structure is the mix of debt and equity used to finance the business. So there's two main sources, debt and equity, and that composes their capital structure. Now the goal is to find the optimal mix of debt and equity to maximize the value of the business. At this point of maximization is when the weighted average cost of this capital is minimized. There's it's called WACC. You see that formula there. Now the cost of equity, there's various formulas that practitioners use to find the cost of equity. On the other hand, the cost of debt is more straightforward. It is the interest rate of all the debt securities that a company may issue, and much more straightforward to find out. So we'll talk about how these companies manage their debt profiles. Looking at the capital structure of businesses that we own, it will vary across industry and the businesses. It's important to understand that debt can be prudently used in a company's capital structure to increase the value of that business. In a taxable world, the use of a tax shield creates value. Interest paid on debt is deductible, so this actually increases the value of that business if used in a prudent manner. Of course, this lower cost debt, and typically it is lower cost debt, can be used to fund higher return projects or R&D, or expanding into a new market, etc. Whatever the company is involved in, they can use low-cost debt and then funnel it into higher return products or services, and this creates value. So the portion of debt used in the capital structure, like I said, is dependent on the industry that the company operates in. I have 3 businesses that we own listed here: Brookfield Infrastructure, Ecolab, and Franco-Nevada. And you can see the differences in the debt of each business. You have net debt to EBITDA. EBITDA is just a proxy of cash flow of the company. And you can see Brookfield sports a higher net debt to EBITDA of 7.4 times, all the way down to Franco, where you see they use no debt. And it's not necessarily bad or good that they use a lot of debt or no debt. It all depends on how it's managed and what industry the business operates in. Firstly, it's important that these businesses, if they are to use debt, that they have defendable and defensive top lines. All the businesses that you own in your portfolio, these are high quality businesses, and there's common characteristics across all of them that we look for. In terms of their top line, for Brookfield, we see that these are inflation-protected contracts on real assets that provide stable revenue streams. These are infrastructure assets. These are power generation assets. These are essential assets needed for the operating of the global economy. A lot of Brookfield's contracts are inflation-protected as well. And when your top line is inflation-protected, and if you have any floating rate debt, they cancel each other out largely. So we have no concern with Brookfield having debt. With Ecolab, they also have a recurring nature of their revenues, and they provide a lot of essential products and services, specifically sanitation, filtered water, hygiene products for a lot of restaurants and hospitality venues. And again, these are essential, especially in light of COVID. And we see recently they've just announced an 8 to 10% increase across their portfolio of products. And this shows that the business has pricing power. Again, you do not want to be a business that has no pricing power and you're very vulnerable to capital markets, or you have an imprudent capital structure, which places you in a vulnerable position. We see in all our businesses, they are strong businesses with high quality revenues, and they're able to weather a rising interest rate environment because their products and services have pricing power. With Franco-Nevada, a precious metal royalty and streamer, we see that there's huge upside from the precious metal prices, and they have no exposure to a ballooning operating costs below the line. Again, defensible top-line revenue growth, which helps them mitigate any below-the-line issues, and in this case, but unique to Franco-Nevada, and again, Wheaton Precious Metals, Sandstorm, Gold Royalty, you may own a variety of these companies all in the same industry. There's no exposure to the ballooning operating costs that may occur at some of these mines. So they capture all of the upside and have very limited downside in terms of costs. In terms of rising interest rates, is this a cause for concern for our businesses? Largely, no. When you look at the business itself and you get away from the headlines that you see and the market action, when you actually look at the business itself, you see all the businesses that we own prudently manage their capital structure. Taking a look at Brookfield Infrastructure specifically, there's 4 main strategies that they implement in maintaining their debt. First of all, they have fixed rate debt. A vast preponderance of their debt is fixed rate at 90%. So while interest rates may increase, they are insulated from this because they have long duration fixed debt. And they've refinanced a lot of this debt over the past couple of years, specifically in the past 2 years, as interest rates have plummeted to 0, or the benchmark rates have. And they refinanced approximately $18 billion alone in 2021. So they actively take advantage of low rates and lock those low rates in. And then thirdly, they have a staggered maturity. So roughly only 10% of their debt comes due each year, with an average duration across their entire portfolio of 8 years. So they've locked in low rates, they've increased the maturity or duration of this debt, and this helps reduce dependency on capital markets. You do not want to be a business that has no pricing power and a vulnerable top line, and also a vulnerable capital structure position. And these are key qualities that we look for in a company. The ones that I've highlighted on the previous page, that they have strong pricing power, prudent capital structure, and they can weather any storm. Lastly, as we take a look at asset level debt, Brookfield owns a lot of infrastructure assets, and the assets themselves have the debt, and it has no recourse to the broader company, which reduces general business risk or contagion risk within the actual company itself. So if there's an issue in one portion or one asset in their business, it largely has no repercussions for the broader portfolio. Like I said, reduces the business level risk. So as interest rates increase, as we see inflation ugly its rear head, we haven't seen this level of inflation for decades really. You have to understand that the businesses you own, they're operated and managed by people that actively think about this. They aren't vulnerable to the capital markets, the volatility that we've especially seen over the past 3 months, and they actively manage their capital structure. So that helps it put into context. You don't own a number on the screen that moves around violently. You own a business, and these businesses are managed by top tier talent. I'll now hand it over to Andrew, who will discuss stock splits.
Over the past month and a half, you may have heard that Alphabet, which is the parent company of Google, and Amazon announced a 20-for-1 stock split. Or you might remember back when Apple announced a stock split on a 4-for-1 basis in August of 2020, or back when Brookfield Renewable announced a 3-for-2 stock split in November of 2020. Or perhaps you might be unfamiliar with the term stock split, or have some cursory understanding of that term. In this presentation, my aim will be to help us better understand what is a stock split, the purpose of a stock split, and how a stock split impacts your investment portfolio. So first, what is a stock split? A stock split is a company decision made by the board of directors with the approval of shareholders to either increase or decrease the number of shares outstanding. The number of shares outstanding is simply the number of shares that are held by all of its shareholders. Now, you may have heard of us say this before, but whenever we buy a stock or some shares in a company, we are purchasing a piece of the business. You become a part owner of the company. Now, there are two main types of stock splits: a forward stock split, which is usually more common, and a reverse stock split, which is just the opposite of a forward stock split. Now, first, a forward stock split. In a forward stock split, shareholders will receive additional shares for each one share that they already own. So, for example, in a 20-for-1 stock split, shareholders will receive 19 additional shares for each one share that they own, giving the shareholder a total of 20 shares in total. Now, you might be asking yourself, if you receive additional shares, does that mean the value of my investment increases? Well, the value of your investment is based on two components: the market price of the stock and the number of shares that you hold. So in a forward stock split, the price of the stock will actually decrease by the same factor as the number of shares increase. Now, imagine this. You just baked a pie, and whether you cut a pie in 4 pieces or 8 pieces, you still have one whole pie until someone eats a piece, of course. Now, in a reverse stock split, the price actually increases by the same factor as the number of shares decrease, giving the market value the same. Now, to better help us understand the concept of a stock split, I have an example for us here on the next slide. Okay, so in our example, I have Amazon as an example. So on March 9th, 2022, Amazon's board of directors approved a 20-for-1 stock split. Now, assume an investor has 10 shares of Amazon and the pre-stock share price is $3,000, giving the total market value, the total investment value of the shareholder, $30,000 prior to the stock split. Now, after the stock split, the investor would have 200 shares or 190 additional shares, giving the shareholder 200 total shares. And the share price will drop or decrease by a factor of 20 to $150. Now, after the stock split, the market value will still remain $30,000. So after the stock split, the market value remains the same prior and post stock split. Now, you might be asking yourself, why do companies choose to split their stock? Well, the primary purpose is for liquidity. Now, liquidity is simply means to make it easier to buy and sell shares of a stock. Now, a company may want to lower the price of its stock in a forced stock split in order to make the company more convenient for shareholders, particularly new shareholders, to purchase. For example, Amazon shares currently trade at just under or around $3,000 US, while Alphabet trades at around $2,600 US. So such a high price might become a barrier to new investors. Now, although some brokerages allow shareholders to purchase fractional shares, which is simply a percent of a share, a stock split would allow a shareholder to purchase a whole share at a relatively lower price. Now, stock splits also facilitates greater efficiency, such as reducing the bid-ask spread, which is simply the difference between the price a buyer is willing to buy and the price a seller is willing to sell. Stock splits also can increase the number of shares in such a way that it will not have such a significant impact when someone purchases a stock. So if there's a reduced amount of shares, purchasing a stock can sometimes substantially increase a stock, or if you're selling a stock, conversely, the share price can decrease quite substantially when there is a limited number of shares. So having a greater number of shares in a forced stock split can increase or facilitate greater liquidity. Now, in the case of a reverse stock split, companies may choose to do a reverse stock split, which is to reduce the number of shares and increase the per share price when the company's share price is at risk of falling below the minimum price per share requirement of an exchange. In that case, it makes sense that a company would want to increase the price of the stock by decreasing the number of shares. Now, a higher share price may also have the perception of being more valuable or having more value. But as we already know, that theoretically, stock split has no impact on the market value of a stock. Now, you might be asking yourself, how does a stock split impact my investment portfolio? Well, firstly, there will be a change in the number of shares that you own. In a forward stock split, you will have more additional shares. In a reverse stock split, you have a less number of shares. Also, in a stock split, the stock price will decrease or increase proportionally to the by the number of shares increasing or decreasing. So that's one thing that you will notice on your statements as well. You will notice that the stock price has decreased or increased depending on the type of stock, and you'll receive additional or have less shares than you had before. Now, usually when a company announces a stock split, the stock, particularly a forward stock split, the price will actually increase. Now, one of the reasons for that is that it just has more attention to the stock. It might attract new investors that might not have owned the stock because of an unfavorable share price range. And so as a result of that, there might be more increased buying as a result. So that's sometimes why you see the price of a stock increase when there's a forward stock split announcement. But theoretically, as we know, the market value theoretically remains the same. Now, in a stock split, you don't have to worry about any tax implications, so there's no tax considerations that you have to worry about. And also about your dividend will not be affected, but rather it will be adjusted to reflect the change in the number of shares. And then lastly, you will still retain the same voting rights after a stock split. So hopefully this better helps you understand a stock split next time when you see some changes in your investment statement.
Thank you very much, Jesse and Andrew, for again filling us in on the impact of interest rates on our investments, and also the whole concept of stock splits and what that means for our investors. So we trust that the webcast has been helpful, and if you have any questions, again, reach out to us, email, call us, and we really appreciate your support. Our next webcast is scheduled for Thursday, June the 23rd, 2022. Thank you very much, and have a wonderful day.